Taxes, the most expensive cost we pay every day to legally live as a human being. And if you are paying investment tax, it means you've already reached an elite status in society. Simply because you have extra money to set aside each month, you are already doing better than 50% of Canadians who are living paycheck to paycheck. As an investor and contributor to the global economy, you deserve to keep your fair share of profits by minimizing taxes on your investment income. In this video, I'll cover all forms of taxes you may encounter when investing in publicly listed securities in Canada, including stocks, bonds, and ETFs. On this channel, I will be sharing all the techniques I've discovered in the past 6 years, which have allowed me to build my investment portfolio to more than $500,000 from scratch. Make sure to subscribe to the channel so you won't miss out. Let's imagine two good friends, Tom and Jerry. Both are highly successful and pay the highest income tax rate of 53% in Canada. Each has invested $100,000 in taxable stock portfolios that return 10% per year. The only difference is that Tom's portfolio pays out the 10% return in dividends, while Jerry's portfolio only appreciates in value. After 20 years, Jerry's portfolio has grown more than 6 times to $670,000, but Tom's portfolio is only worth a meager $320,000. What went wrong for Tom's portfolio, even though he is getting the exact same investment return, and how to prevent this kind of loss from happening? Keep watching and you will find out why. Most investments are taxed on 3 types of incomes: capital gains, dividends, and interest incomes. You can easily determine your capital gains tax rate using this wonderful table provided by the taxtips.ca. Please note that the data shown is for the Ontario province only. You can find the tax rate for other provinces in the description below. It is not hard to notice that the capital gains tax rate is highly advantageous at higher tax brackets because only 50% of your profits are taxable. And the biggest advantage above all, you don't need to pay this tax at all until you sell, allowing the power of compounding to work to its full potential. This is the reason why Jerry's portfolio performed significantly better in the previous example. Any dividends you receive from stocks or ETFs are taxed every year, whether you take them in cash or reinvest them immediately. Let's quickly review the almighty tax rate table again to find the dividend tax rates. You will notice that dividends are taxed at much lower rate compared to regular income. This advantage is particularly powerful if you plan to retire early and live solely on dividend income in a lower tax bracket. In Canada, most investors encounter 2 types of dividends: eligible dividends and foreign dividends. Eligible dividends are paid by Canadian stocks or ETFs that exclusively hold Canadian companies. These dividends come with a tax credit, resulting in a lower tax rate. If you hold any U.S. dividend stocks, you're receiving foreign dividends. These dividends are taxed as regular income at your highest marginal tax rate if held in a taxable account. Simply add foreign dividends to your total income, and you can easily determine the tax rate. If you hold your U.S. stocks in an RRSP account, your dividends are completely tax-free. But if you hold non-U.S. stocks in RRSP account, or any foreign stocks in other registered accounts, you will have to pay a withholding tax to foreign government where the company is located. The withholding tax rate for U.S. stock dividends are 15%. Withholding rate can be different for other countries. Take Japan, for example. You can simply search for the tax treaty between Canada and Japan on Google. Find the treaty on the government's website and search for dividends. You will find the withholding tax rate is 15%. Smart viewers should have already noticed that high dividend foreign stocks are very tax inefficient. It's better to look for foreign stocks that pay little to no dividends but appreciate in value. The only exception is U.S. dividend stocks, which can be held tax-free in an RRSP account. Here is a summary for foreign dividend tax. Make sure to save this timestamp for future review. Many people enjoy investing in the S&P 500 index through Canadian-listed ETFs, such as VFV, but they have no idea that a withholding tax is charged at the fund level when dividends are paid out from the underlying holdings. This means that if the underlying U.S. companies pay $100 in dividends, the ETF fund will only distribute $85 after the 15% withholding tax is deducted. Keep in mind that if you hold VFE in your RRSP account, you won't be able to recover any withholding tax paid at the funds level, so it is better to purchase the US-listed SP 500 Index ETF instead, such as VOO, to get the full dividend amount tax-free. Dividends from real estate investment trusts are taxed as ordinary income at your highest marginal tax rate. To make matters worse, these public trusts are legally required to pay out the majority of their profits as dividends, which means being taxed at a high rate on those dividends can significantly reduce your total returns. Therefore, always hold your real estate investment trusts in registered accounts. To find out if a public traded stock is a real estate investment trust, simply check if its ticker ends with the letter UN. Interest income is the safest type of investment income you can earn, typically from bonds, GICs, and savings accounts at banks. And just as you guessed, you have to pay tax on any interest earned, and what's better, you will pay the highest marginal tax rate. The same tax rate applies to any fixed income ETFs as well. Fortunately, there are ways to minimize the tax paid on interests. You can either hold your investments in registered accounts or invest in ETFs such as HSAV and HSUVU. These ETFs reinvest interests immediately without paying out any cash, leading to consistent tax-free share value appreciation. This way, you only need to pay capital gains tax when you decide to sell, effectively reducing your tax burden by 50%. The primary goal of tax optimization is to achieve uninterrupted compounding of our invested capital. As demonstrated in the example at the start of this video, any tax losses during the compounding process can lead to significant underperformance over the long term. I have created a cheat sheet summarizing the most tax-efficient ways to hold various types of investments, shown here on the screen. This should cover most situations, with one exception. If your income is below $102,894, it might make more sense to hold high dividend stocks in non-registered accounts due to the much higher capital gains tax rate when you sell your shares. This amount can add up quickly even if you are a long-term investor and only plan to sell small amounts of shares infrequently. By the way, if you wish to level up your wealth into the next level and unlock the ultimate freedom, make sure to show some love by hitting the like and subscribe button. See you next time.